Welcome back, everyone. So, in today's explainer, we're going to demystify something that literally dictates our entire global financial system, but is honestly so heavily misunderstood. We are talking about the true mechanics of the stock market. We're going to just strip away all that Wall Street jargon and get right down to the cold, hard reality of how this massive machine actually operates.
And I actually want to start by challenging a pretty core assumption. Think about the last time you opened up your trading app. You tap buy, the money leaves your account, and poof, the shares magically appear in your portfolio. It feels entirely seamless, right? But when you buy a stock, who exactly gets your money? Like, where does that cash physically go?
Well, most of us subconsciously operate on what I call the donation box myth. We kind of just believe that if you buy, say, $200 worth of Apple stock, Apple takes that cash and uses it to build the next iPhone or, pay their software engineers. But that is completely wrong. When you hit buy, you are absolutely not paying the company. You're actually paying a total stranger, someone you will never meet who simply woke up today and decided, hey, it's a good day to sell. Which brings us to this incredibly shocking reality. Apple didn't get a single cent of your transaction. Zero. They don't even know you exist, and they were totally uninvolved in the trade. Yet, somehow, that transaction between you and a total stranger just moved a number on a screen, maybe contributed to global financial headlines, and marginally shifted the retirement savings of millions of people around the world. And it did all of that in a fraction of a second. So if the company isn't actually involved in our day-to-day trading, what just happened? And why on earth is this system built this way? Okay, let's really dive into this. To understand the market today, we actually have to look at the human problem it was originally built to solve. So let's travel way back to Amsterdam in the year 1602. Imagine you're a merchant chasing a fortune in Asian spices, but outfitting a massive ship is incredibly expensive, and facing pirates or crazy storms all by yourself, that means extreme financial ruin if things go south. Literally, no single person could afford that level of risk. So the brilliant solution? Split the funding. Dozens of people chip in a much smaller amount. If the ship returns, everybody shares the profit proportionally. If it sinks, well, the risk was distributed and no one is completely ruined. This was the Dutch East India Company, which is widely considered the very first company to ever issue shares to the public. And those trading apps we use today, they're just this exact same idea, just scaled way up and made instant. So what are you actually buying today? Let's be really precise about this idea of ownership. It's not like you get a physical desk at Apple headquarters, and you certainly can't walk into an Amazon warehouse and just start handing out boxes. What you own is actually far more abstract, and in a lot of ways, much more powerful. You own a claim on the future value of a business.
Think of it kind of like owning a slice of a pizza that hasn't actually been baked yet. You don't know exactly how big or how delicious that pizza is going to be. But if the whole pizza grows, if the company earns more money, expands into new markets, gets more valuable, your slice grows right along with it. But crucially, and this is the catch, if the pizza burns, your slice burns too. That is the fundamental deal of the stock market. Ownership means you are sharing in both the upside and the risk.
But let's flip the perspective for a second and look at this from the company's side. Why would a successful business willingly give away pieces of itself to total strangers? Well, let's say you run a really great small coffee chain. You've got 5 locations and you want to rapidly expand to 50. Doing that requires an enormous amount of money for real estate, fancy new espresso machines, staff, marketing, the whole shebang. Now you have a few options to get that cash. Option 1, a bank loan. But that requires strict monthly interest payments, which can literally bleed you dry before your new shops even turn a profit. Option 2, you find a wealthy single backer, but they will inevitably demand massive influence over your strategic decisions. Or option 3, you can sell shares to the public. This lets you raise debt-free capital from thousands of investors all at once, with absolutely no monthly interest dragging you down and no single billionaire whispering in your ear telling you what to do. And this brings us to a massively important concept, the initial public offering, or IPO. This is the big fundraising event where a company first sells its shares to the public. And I really want to emphasize this because this is the one and only moment where your money actually does go directly to the company. If you buy a share during an IPO, you are handing your cash directly to the business to fund their growth. And in exchange, they're handing you a freshly minted slice of that unbaked pizza. Now, sometimes an already public company might issue new shares to raise more capital later on, and again, in that specific instance, the money goes to the company. So the crucial point here is understanding this major divide. The primary market is that initial IPO event where money flows straight from the investors to the company. But literally everything that happens after day one, That is the secondary market. Once those shares are out in the wild, the company completely steps aside. Investors are just trading existing shares with each other, and the company is merely a bystander. The stock price you see on your screen isn't a measure of how much money the company has sitting in its bank account from selling shares. Actually, it is purely a measure of what investors believe the company is worth right now. So since the company isn't involved in the secondary market anymore, buyers and sellers need a way to find each other. And that is exactly where stock exchanges come into play. When you hear about the New York Stock Exchange or the NASDAQ, don't picture some chaotic physical building with guys in suits yelling at each other. Picture an incredibly regulated, lightning-fast matchmaking system. When you hit buy on your app, you aren't personally hunting for a seller. Your broker routes your order to the exchange's algorithms to find a stranger who's willing to sell at your exact price, and it completes that match in literal milliseconds. But who exactly is using these matchmaking systems? Because the market isn't just one big homogeneous crowd. It's an entire ecosystem of vastly different players. You've got retail investors. That's regular people looking for long-term growth with a relatively small individual footprint. Contrast them with short-term traders who are trying to profit off rapid, high-stress price swings. Then you have the whales, institutional investors like pension funds and hedge funds, managing billions of dollars and shifting the entire market's gravity. And finally, market makers. They sit quietly right in the middle on both sides of every single trade, profiting on tiny differences in price, but providing the critical liquidity that actually lets everyone else trade smoothly.
And you really have to grasp the sheer gravity of those institutional investors. We are talking about thousands of millions, frankly billions and sometimes even trillions of dollars managed by these huge entities. With their armies of research teams and crazy algorithmic advantages, they possess a scale that retail investors simply cannot match. When a massive hedge fund decides to move into or out of a position, they literally drag the market with them. Now let's move to how this all builds together. Because at its absolute core, this entire system runs on just two numbers for every single stock. The bid, which is the highest price a buyer is currently willing to pay, and the ask, which is the lowest price a seller is currently willing to accept. The entire market is basically just a constant, aggressive negotiation between those two sides. And when those two numbers finally meet, a trade happens. That exact point of agreement between a willing buyer and a willing seller in that millisecond, that becomes the official, latest reported price of the stock. That's the ticker price you see scrolling across the bottom of the screen on a news channel. This is the fundamental law of supply and demand in real-time action. If some wildly positive news breaks, buyers suddenly flood the matchmaking system. But because there aren't enough sellers to go around, desperate buyers start competing. They push their bids higher and higher just to convince someone, anyone, to sell. And as sellers take advantage of that and accept those higher bids, the official stock price climbs. And the exact reverse is true for sure. If sellers panic and suddenly outnumber buyers, they have to undercut each other's asks just to attract a buyer, and the price plummets. And this brilliantly illustrates the ultimate kind of mind-bending twist of the stock market. Because prices are driven entirely by buyers and sellers, they don't just react to reality, they react to expectations. Like a perfectly profitable, reliable company can announce record earnings. But if investors firmly expected those earnings to be even higher, they get disappointed, they sell, and the stock drops anyway. Conversely, you can have a zero-revenue startup boasting a billion-dollar valuation simply because enough buyers fiercely believe in its future potential.
So what does this all mean? It leaves us with this final really fascinating thought. If a company can post absolute record profits, yet watch its stock drop right before its eyes, what is the market actually trading? Well, it's not just trading current realities. It's trading human psychology, belief, and expectations of the future. So the next time you look at a stock chart, just remember, you aren't just looking at a company's bank account. You are looking at a real-time ledger of what the world believes is going to happen tomorrow. Thank you so much for joining me in this explainer today. Keep questioning the mechanics behind the curtain, and I'll catch you in the next one.